Hey guys, what's up? This is Gangsha and welcome back to my channel. In today's video, I am going to talk about debt funds, when and why you should invest in debt funds, and what are the different kinds of debt funds available in the market. Most people end up keeping their money in the bank or as fixed deposit. I came across this option, which I feel is the better option than FD. So I tried making a little package about debt funds with my research. So what is debt funds? It's a debt which you are giving to government and different corporate institutions to support their financial needs. It works exactly like bank loan, but here you are the one in the giving end and they are in the receiving end. And the debt mutual fund is the big basket of all the debt bonds of different companies and entities. The debt manager take your money and they can generate good returns by allocating it to different government and corporate bonds, treasury bills or other financial securities, and they share the returns with you. They have a fixed period of maturity and a fixed rate of interest. Debt funds are less risky than other mutual funds because they don't invest in the equity market for returns. You can buy these debt funds from any bank or trading account. I will explain it elaboratively in my next video, so make sure you subscribe to my channel. Now, what is the difference between FD and debt funds? In FD, you lend some money to the bank and the bank gives you fixed interest based on your amount and the tenure that you are keeping your money for. When you check this chart provided by Reserve Bank for interest rates, you could see how the interest rates are decreasing every year from 2012 onwards. On the other hand, debt funds are the big basket of such loans to government or corporate industries, etc. Here your interest is not only coming from one single bank but from different government and corporate establishments. So it's a collection of debts that you are giving to different establishments and hence your portfolio is more diversified here. I also want to add one frugal point of this investment, that is, when you put your money in FDs and break it in between your tenure, it's not going to give you anything as an interest. But if you put your money in debt funds, then you might make some money out of it even if you break it within few months. Now the next topic is when to go for debt mutual funds investment. When you have extra cash as an emergency fund or for any short-term goals like education, buying a car, or you are saving for a vacation, then where should you invest it? Investing in equity for short-term goals is not a good option because the liquidity is very low. That means you cannot withdraw your money within a day or hours. So, for short-term goals, you can choose debt funds. Also, debt funds can be used to park your bonus. For example, at this moment, you don't know what productive to do with your money or market is not giving you good opportunity to go in. So for that time, you can hold your money in debt funds. That way you will gain few bucks as well as your money is in less risky corner. There could be different reasons to go for debt funds, but the first thing you need to do is to identify your need or reason to invest in debt funds. So choosing a debt fund according to your need is really important. There are few debt funds which have higher risk than mutual funds or equity. So don't choose any debt funds randomly. Do your research well and then go for it. There are also many risks attached with debt funds. First is credit risk. For example, you have given your money to any company X and after few months that company goes bankrupt and they cannot give your money back. This is called credit risk. So how to deal with them? There are so many credit rating companies in India like CRISIL, CARE, ICRA, etc. These companies rate the bonds or other financial instruments where your debt fund manager is putting your money. So before investing in any debt funds, make sure you check their credit rating. Next is liquidity risk. For example, you have given your money to any company X and after few months, that company tells you that you can only get your money back after the maturity period. That means you may not be able to withdraw your money when you need it. This is liquidity risk. And now this leads to the third risk, which is interest rate risk. Let's say you have one bond and you don't want to hold it till maturity period. So now you can trade your bond in secondary market. For example, you buy one bond with interest rate 7% and after few months, the same bond reduces their interest rate to 5%. then there will be demand for your 7% bond in the secondary market and your bond price will increase. This can work other way as well. If you got the bond for 7% interest rate and now company is giving 9% interest on bonds, then nobody will buy your bond with 7% interest rate in secondary market. So your bond price will reduce in the secondary market. This is interest rate risk. There are various types of debt funds available in the market depending on the maturity period of the funds. Let's see what are the different types of debt funds. First is liquid funds. As the name suggests, you can liquidate it anytime you want. You can take the money out within a few days or months or keep it as long as you want. This is the lowest risk funds and good alternative for savings in the bank. When you only want to park your money and you currently don't know the use of it, then it's more likely to give you better returns than bank savings. Second is short-term or ultra short-term funds. In these type of funds, an investor generally invests for very short period of time, for example 3 to 12 months. Also, they are low risk funds. Third is dynamic bond funds. In these type of funds, your portfolio manager keeps changing the interest rate regime. You will not get a fixed maturity period if you opt for these funds because it has fluctuating maturity period. For example, if the asset manager thinks that an interest rate cycle is about to fall, then he or she can increase its portfolio tenure. Similarly, if the asset manager thinks that the rate have hit bottom, then they can reduce the portfolio's average maturity in short notice. So they play around to give you better returns. Next is gilt funds. If you want funds that only invest in government securities, then you should invest in gilt debt funds. It has been rated most secure. These securities will have low credit risk because they are protected by government policies. If you need to invest your money for 3 to 5 years or more than that and you are looking for lower risk option than equity, then you can opt for gilt debt funds. Next is credit risk fund. Under these type of funds, the fund manager invests in little lower credit rating instruments to gain little higher returns. These are high risk funds. Next is banking and PSU funds. As the name suggests, it only invests in banking and public sector funds. They also give low credit risk and your fund will be more secured. You can choose these funds if you want to invest for medium term like 3 to 5 years. Next is income funds. These funds mostly invest in securities which offer long maturity and they also invest in debt funds with distinctive maturity period. These are better than dynamic funds. The period of 5 to 6 years is the average maturity period for these kind of funds. So debt funds come with benefits like high liquidity, low risk and predictable returns. Also, debt funds are tax efficient investment if you keep it for more than 3 years. So in my opinion, debt mutual funds are definitely great investment option if you select them smartly based on your investment objective and risk appetite. So this video is the first part of debt funds. In the second part, I'll be talking about things to keep in mind before buying any debt funds and from where you can buy the debt funds. So make sure you subscribe to my channel and turn on the notification bell so you will be notified when I come up with a new video. Thank you so much for watching the video guys. I'll see you guys in the next video. Until then, stay safe. Bye-bye.